The information provided in this program is of a general nature and is not intended to be personalised financial advice. We encourage you to seek appropriate advice from a qualified professional to suit your individual circumstances. Tech giants are going all in on AI. Between Meta, Amazon, Google and Microsoft, who's got the upper hand on artificial intelligence?
Google did have the jump, they didn't use it. They're now playing catch up.
And BlackRock Australasia tells me what its favourite asset is right now. I'll give you a clue, it's not equities.
We do have this view at BlackRock around, we think that inflation may be sticky.
It's Monday the 1st of May and you're watching Markets with Madison. The world's biggest tech companies are cutting jobs and expansion plans, but they're betting big on artificial intelligence. All the big names saw revenue growth in the first 3 months of this year, beating market expectations. I caught up with Jarden's global equity analyst Jeremy Ward last week, just after Amazon released its first quarter result. Jeremy, thanks so much for joining us. Tech, you must be a happy man this week.
Yes, some good results. Amazon specifically overnight, really good result. Better than expected on both the cloud front and the retail online front. We're seeing some consumers trade down and use Amazon as a staple.
How does the current pace of revenue growth compare historically? And how is the contribution mix to revenue for these companies changing?
We saw a lot of companies run to the cloud on COVID, putting a lot of processes on there. The market went through a bit of a cost rationalization in terms of, do we really need to put everything on the cloud, or what are all these lines that are costing quite a bit? And there was a bit of cost rationalization from a lot of companies with that. But what we've now seen is, with obviously the adoption of AI, a lot of those companies are now sort of reserving space to put large language models in training mode on those cloud platforms.
On artificial intelligence, where are each of these tech giants at with it, and who's set to win?
Clearly Microsoft at the moment. They were early funders of OpenAI, so they've got an agreement there which has gone very well. Surprisingly, the jump in sort of technology was done inside of Google, and they held on to it for a while. So, Google did have the jump, they didn't use it. They're now playing catch up. Their system Bard is not as good as ChatGPT. So, really interesting that Microsoft is sort of taken this and really run with it. What we're seeing also with the combination ChatGPT and Bing, really strong growth, drawing users away from Google. So, Google has such a dominant share in search. I think it's a 1% shift in search, from Google to Bing is worth $2 billion to Microsoft. So huge in terms of the sway factor, and that's really starting to gain traction. So Microsoft a clear winner there over Google.
How much upside opportunity is there in that when it comes to rev?
Really good question. It could be quite significant. It's not 100% clear how they're going to charge going forwards. At the moment you can get a professional subscription, $20 a month. But I think that, as these evolve and, it becomes tailored to you, so it knows you better and it gives you good results, how much are you going to pay to keep that AI knowledge of you so you get better results? I think that's more the question, is like, what is the consumer willing to pay? But we're just in the early stages. A lot of this is sort of trained on 2-year-old data. What we need is up-to-date data.
Staying with Microsoft, but this time I want to compare it not with Google but with Amazon when it comes to cloud. Is cloud collapsing? What's happening there?
I don't think it's collapsing. I think there's just been a consolidation period, and we have seen really strong numbers from the Microsoft Azure cloud, because businesses are really sort of using it to their advantage. Cutting costs in other areas such as staffing or management, and trying to automate processes, and that all plays to the cloud.
I want to talk about costs. Job cuts, the obvious one. How would you describe, you've called it a rationalization, but how would you describe operationally what they're doing with cost in terms of how significant it is historically, and are they doing enough?
Yeah, really good question. I think it depends on which company. We saw some heavy cost cuts on the Meta, Facebook sort of side. That has now proven to be quite fruitful. They had sort of 3 quarters of negative growth, and they've just come out with results recently, up 14% on their first sort of positive quarter of growth in a while. So it depends, how deep some of the companies went. AWS, Amazon, paused a number of large facilities just because, they had a very long runway of growth in terms of their outlook, and, they were forced to cost rationalize as well. So, I think it's been a pretty short, sharp cost reduction, but, there's a bit of time to see how the rest of the year will play out, and when that growth returns to the market. But yeah, in terms of the spend, there was a lot of spending, a lot of very long-term growth plans. Hence, very high multiples that have come down accordingly.
Too optimistic previously, perhaps?
Definitely, given the economic backdrop, and there may be more to go on the PE drop.
They're behemoths now. Will they still be big tech giants in, say, a decade's time?
Very good question. I think there's going to be some clear winners and losers. The AI shift is very rapid, so you can see some pretty fast-moving market shares in that sense. Inevitably, 3 cloud players. It's a very competitive market, and there's been a lot of money spent. So each have got sort of different markets carved out, but is that going to continue going forwards? Not so sure.
If you could pick one to back, who is it?
At the moment, definitely Microsoft, because they've got that, the Office relationship with corporates, and with that cloud, they can just add on other services. They can add on to ChatGPT as well as your Outlook, Excel, Word. I think for the moment, that they look the most promising.
Hey, thanks so much for your time, Jeremy. Good to chat.
Thank you.
Despite a positive surprise with tech earnings, BlackRock is cautious on equities. Its head of multi-asset strategies in Australasia, David Griffith, who also looks after asset allocation for ASB's client funds, says there's other assets he likes more than equities right now. Hey, David, great to have you on the show.
Nice to be here. Thank you.
US earnings season is currently in the thick of it right now. What key messages and potential economic challenges have you seen crop up in these companies' results and commentary?
Yeah, sure. It's been really interesting. I mean, so far, I guess earnings have been kind of a little bit better than expected, actually. So the earnings season is going okay. We're about sort of halfway through. And so far it's turning out to be okay. We would have thought we are, a little bit cautious around the outlook for earnings at the moment. We think there's a little bit of, too good news priced into earnings. So we are expecting to see, some of the inflation effects starting to feed through into higher costs. But we haven't really seen that coming through to the full degree yet. So yeah, really watching that closely to see how it unfolds. But just a little bit cautious on the forward-looking earnings outlook right now.
When do you expect us to see a bit more damage when it comes to company earnings?
Well, that's the key question. So far the last few earnings seasons have been pretty resilient. Sooner or later, those cost pressures, it does take time. So one of the things about monetary policy is there's this lag effect. So it does take a bit of time for that to feed through to the economy. The great thing would be if it didn't have that effect and we continue to see strong earnings outcomes, that would be the Goldilocks outcome for markets. Certainly as we progress through the rest of 2023 and the next couple of earnings seasons, I think will be really important to watch.
Look, I understand that you've just undergone a bit of an asset reallocation. What moved and why?
Yeah, so look, we've been always reviewing the portfolios, but we tend to review the sort of more strategic views of the portfolio on an annual basis. There's following 2022, we are seeing some better opportunities, particularly in fixed income markets. Obviously, bond yields have moved a long way from where they were, say, 12 months ago. And that's really opened up some new opportunities within fixed income. So for much of 2022, we've been positioned primarily at the shorter end of fixed income curves. And as we sort of progress and, there is sort of potential risks of recession on the horizon further out, thinking about moving further out the maturity spectrum in fixed income to add a bit more sort of protection in the portfolio. And also investing in inflation-linked bonds, which the performance tends to be more tied to the, inflation, the realized inflation outcomes over the medium to long term. We do have this view at BlackRock around, we think that inflation may be sticky. Some of it is transitory, but a big chunk of it we think is more structural. And this is sort of tied to some sort of longer term trends around demographics, deglobalization, and decarbonization of the global economy. We think those sort of structural trends will play out over the next few years. So, like, one of the challenges that central banks face is, they really want to see inflation coming down without impacting growth too much. But we think ultimately they're going to need to live with a certain level of inflation and potentially not get inflation all the way back down to their targets.
Such a critical year for fixed income, given the state of interest rates and what's even happened in just, say, the past 12 to 6 months. So if that's how you're positioned, what are you exactly looking for on either the economic data side or in possibly central bank monetary policy actions that could change your view, and what are those scenarios that would cause you to act?
Yeah, so it's really interesting at the moment. We're sort of at this inflection point. So, obviously central banks have reacted to the inflation environment. They've been aggressively hiking interest rates. So really we're in this sort of wait and see mode to see how all that impacts, economies. So, when we think about scenarios, you can maybe have a Goldilocks scenario where we navigate this environment, inflation starts coming down, and we don't have a major impact in terms of economic growth. Or we have the opposite of that, maybe like a stagflation environment where inflation is still really sticky. And no matter what central banks can do, raising interest rates is a pretty blunt instrument to use. That could really start to dampen growth and push economies over the edge into recession. And then all of a sudden you've got, negative economic growth and there's still a positive inflation environment, which is not great. So they're the sort of the bookends of the scenarios. I would say we're sort of somewhere in between in terms of our outlook. We sort of think, as I mentioned before, inflation is going to be a little bit sticky on the high side. The good news is we are starting to see inflation coming down from the peak. US inflation down from 9% down to about 5% now. We're starting to see some incremental improvements in New Zealand, but still a little bit sticky there. But we do foresee like a mild recession in both the US and Europe and other parts of different parts of the world where we have seen this really aggressive stance in terms of monetary policy. So right now, in terms of how we're seeing the outlook, we're a little bit cautious, I would say, in terms of the portfolio positions.
If fixed income is where you see upside opportunity at the moment, what are you avoiding?
What are we avoiding? That's a good question. So I don't think we're avoiding. I think the way we build portfolios is more around looking at the sort of risk return outcomes and sort of rank ordering different asset classes. Ultimately, you want to make sure that in this environment where there is a bit of uncertainty, it's really important to maintain diversification in the portfolio. So really for us, it's more about seeking other ways to add that diversification. And I'll give you a couple of examples of that. One is, we've got an allocation to gold. So, an environment where you haven't really had that diversification benefit coming through from fixed income, having gold as an additional sort of defensive asset in the portfolio really helps to aid in that diversification when you're not getting it elsewhere. And then the second component, which is quite unique to both New Zealand and Australia, the currency. So the New Zealand dollar tends to be a bit of a pro-cyclical currency. It tends to do well when equity markets are rising and there's positive risk sentiment. And an environment where risk sentiment starts to turn and equities fall, you typically see a depreciation of the New Zealand dollar. And that's exactly what we saw in 2022, right? And the way we think about that is at the whole portfolio level, we want to have a bit of exposure to foreign currencies. So if you think about the flip side of that, New Zealand dollar depreciates, and then what happens is those foreign currencies appreciate. So in an environment where you're a little bit concerned and a bit cautious about the direction of markets, and there's a bit more uncertainty, having a bit of that foreign currency exposure adds an extra layer of diversification at the whole portfolio level.
If you could use one word to describe how you're positioned right now, what would it be?
Cautious would be the word, I would say. Yeah, a bit defensive and a little bit cautious. But again, constantly reviewing, and as you mentioned, those scenarios that you outlined, it's important to be nimble in these sort of in this market environment.
Cautious and nimble, both really good words. Hey, thanks so much for your time, David. Lovely to chat to you.
Thanks very much.
Here's 3 things you need to know for the trading week ahead. The US banking crisis has only just begun. Another regional bank, First Republic, is heading for receivership, with regulators set to seize and sell it, probably to a bigger bank like JP Chase. Listed cannabis company Cannasouth will merge with Bay of Plenty cannabis company Equalis after getting shareholder approval. It got the green light in a meeting late last week. Look out for an update regarding a capital raising on the NZX today. And more earnings are on the way. Apple and ANZ Bank are releasing financial results this Friday. I'm interviewing the bank's chief executive, Antonia Watson, so if you have any questions you want me to ask her, email them my way. Until then, go and put your money to work. Thanks for watching Markets with Madison, the New Zealand Herald show for interested investors. If you want to stay up to date with financial markets, click the subscribe button below and you can watch our other episodes here. Stay up to date with all the business news and numbers as they land on nzherald.co.nz.